Welcome to Behind the Advice, the podcast for Australians living abroad who want to maximise their financial situation. I'm your host, Mitchell Kelsey, a financial advisor at Runway Wealth Management, and in each episode, I'll be sitting down with other experts and professionals to get their insights, stories, and expertise on key concepts for Australian expats, as well as providing my own perspective. With this being a financial podcast, there is a disclaimer, so any information that you hear in today's episode is general information only. It is not personal advice, so it does not take into account your personal situation, goals, or objectives. If you do need personal advice, feel free to reach out to us at Runway Wealth Management for personal financial advice. Welcome back to another episode of the Behind the Advice Australia podcast. Today we're discussing a topic that's highly relevant for the many Australians who choose to live and work across the Tasman, and that is how to manage your tax and financial planning as an Australian expat in New Zealand. Today I'm joined by Connie Lui, tax advisor and director of NZ International Tax and Property Advisors. Connie specialises in helping clients navigate the complexities of cross-border tax between Australia and New Zealand. Connie, thanks so much for joining me. It's great to have you on the podcast today.
Thank you.
So I think before we jump into today's topic, can you tell us a little bit about yourself and how you came to specializing in helping Australians and international clients navigate New Zealand tax?
Certainly. So thanks so much for the opportunity to join you with the podcast today. So my background, I've been working in the New Zealand tax industry for around 16 years now. I've worked at Big Four, mid-tier and boutique cross-border tax firm, and I've earned that experience through working in those firms. After more than 10 years of working for other people, I started to start my own business, and I've been running my company in the International Tax and Property Advisors for the last 6 years. So it's been really good so far, very rewarding and satisfying, and it's been great being able to help people with cross-border tax matters, especially Australians and also as well as non-Australians as well, with their tax matters.
Yeah, absolutely. And it's a highly specialized area. I think just working cross borders, interpreting double taxation agreements. So it's certainly a little bit different, I suspect, from traditional, New Zealand tax work.
Definitely. I think that's the challenging part, makes the work really interesting. And
yes.
Yeah,
absolutely. Can completely agree. So let's get into the podcast for today. So the first segment is looking to just better understand or give listeners a better understanding of the New Zealand tax system. So for Australians in particular, so for Australians moving across the Tasman, what's the first thing that they need to understand about becoming a New Zealand tax resident?
Yeah, so there are two tests to become a New Zealand tax resident. The first one is the 183 days presence test. Mm-hmm. So in any 12-month period, so it doesn't have to be consecutive. So that's one of the tests, and the other test is the permanent place of abode test. The taxpayer only need to satisfy one of the tests to achieve New Zealand tax resident status. So it's if the person stays in New Zealand for more than 183 days, then there's a good chance they'll become a New Zealand tax resident. There's been a new category that's been introduced at the start of this financial year, and that is called the non-resident visitor category. Okay. So it's predominantly for people who move to New Zealand just to kind of like have a temporary work, mm-hmm. and then they go back to their home country, and it's just visiting here, and then that actually they've extended the 183 days test to 270 days in an 18-month period. Yep. So that gives a bit more, I think, more lenience to people staying longer than 183 days. So that's definitely something to consider when we look at tax residency now, and see if there's any opportunities to be considered a non-resident visitor than a New Zealand tax resident, because as a New Zealand tax resident, it comes with a lot of New Zealand tax obligations.
Yeah, sure.
It's best to be in a non-resident kind of category.
Yeah, absolutely, and that's a really interesting insight in terms of just some additional tax residency rules that you guys have in place over there. Are there any kind of common mistakes that you see Australians make when it comes to their tax residency?
We've seen, I think, not just Australian, but just really people who's coming to New Zealand. They kind of think that they've got assets and investments overseas, and they've paid the tax overseas, and so they don't think they need to report the income from the overseas asset in New Zealand because tax has already been paid. So they don't think they've got to report here, and that's when problem comes because there is a reporting requirement for taxpayers who receive overseas income and they still have a reporting requirement in New Zealand. There is an exemption for people who are a transitional resident, but they need to be satisfying all the criteria before they can use the transitional residency status. So that's a common kind of mistake that we've seen new migrants coming to New Zealand and this.
Yeah, sure. And that's a really good segue because I really wanted to pick your brain about the transitional residency rules. I understand there's a few countries that have these or similar kinds of rules where essentially you can arrive in a country and for a set period of time, you don't have to, I guess, you're not taxable. You're not taxed on your overseas income. With New Zealand's transitional residency rules, can you just explain to listeners how those work?
So it's it's almost automatic. It's something that is automatically granted if the taxpayer satisfy all the criteria as a transitional resident. The criteria include that this is their first time living in New Zealand. They have not been a New Zealand tax resident in the last 10 years. So this rule is not just for new migrants. It's also for returning Kiwi expats as well. But they have to be out of the country for at least 10 years before they could use this tax concession. That's one of the criteria. And another criteria is that they have to satisfy the tax residency status. So they have to either have acquired a permanent place of abode or satisfy the 183 days. The other criteria is making sure that the taxpayer have not done certain things. So, for instance, they've not ceased New Zealand tax residency status. If they've ceased it, then transitional residency status won't last for the full 4 years. It would cease from the date they cease New Zealand tax residency. So that's one situation to watch out for. The other one is not to apply for working for family tax credits in New Zealand, because once the taxpayer applies for it, the transitional residency status would end.
Okay, interesting.
So that's another thing not to do. The other thing is not to notify the commissioner. They want to elect out of the transitional residency status. One way could be that for instance, in the tax return, the taxpayer inadvertently reported overseas income which they shouldn't have under the transitional residency status, then the IRD would see that as notifying the commissioner they want to elect out of the transitional residency status because they've taken a tax position as if they're not a transitional resident. So those are the details of what not to do.
It sounds like there's a few ways that you can kind of accidentally opt out of this transitional residency framework, which you obviously probably wouldn't want to do. And I've also heard a few cases where Australians have moved to New Zealand and not realizing that maybe within 10 years, so maybe 8 or 9 years ago, they lived in New Zealand for a period of time, and they actually they triggered those transitional tax residency rules back then. So when they've come the second time round, within a 10-year period, they're not eligible for the transitional tax residency rules because they're only available once, as I understand it.
That's correct. Yeah. That's right.
And so if I'm an Australian expat moving to New Zealand, I'm eligible for the transitional tax residency rules for that 4-year period. So what kind of foreign income is exempt from New Zealand tax?
Most foreign income, like foreign rental income, foreign dividend, foreign interest income, there are two carves out, and that's foreign employment income and foreign personal services income. So, for instance, if the New Zealand resident taxpayer, still works for the foreign company or a foreign employer, then that income is still subject to New Zealand tax, regardless of the transitional residency status.
Yeah. Okay.
those are the two key carve out from that.
Yeah, okay. So typically if an Australian's got some investment properties in Australia, maybe a share portfolio, that's kind of outside the scope of New Zealand tax for the first 4 years.
Yeah, that's right.
And as a transitional tax resident, what are the typical annual tax obligations in New Zealand?
Sorry, would you mind just repeating that question?
Oh, so as a transitional tax resident, what are the annual tax obligations with the IRD, the Inland Revenue Department?
It depends on whether they have got any New Zealand sourced income. Because if they've got New Zealand sourced income and that needs to be, where tax is not withheld at source, then we need to file a New Zealand tax return for them. And if they've got foreign employment income and foreign personal services income, then they also have a tax filing requirement. So that's kind of, it depends on the sources of income.
Yeah, sure.
And the type.
Okay. And then with the way that the New Zealand tax system works, I understand the New Zealand tax year runs from the 1st of April to the 31st of March.
Yeah.
In Australia, we have a self-assessment model. So you kind of report your income, and then you're also able to claim any appropriate tax deductions as well. Does New Zealand have tax deductions as well that you can claim?
For individuals, it's quite limited.
Yeah,
it's limited because we've got something in the tax law that limits private expense deductions. So in Australia, I think I've heard that you guys can deduct a lot of type of personal expenses, whereas in New Zealand, we are unable to. So what we can deduct that I've seen for individuals are mainly like accounting fees for preparing tax returns, income protection insurance, and I've also seen individuals claiming donation rebates.
Nice.
So we've got a 33.33% kind of rebate on donations in New Zealand. So
so there is still some tax deductions that New Zealanders can claim.
But not as much as Australia individuals can. Yeah.
Well, it probably makes their tax affairs a little bit more straightforward. I think a lot of the tax is already withheld by the employer, similarly to here in Australia. And then if you've got limited tax deductions, maybe it makes the tax returns a little bit more straightforward than Australia, I suspect.
Because not all New Zealand tax residents need to file a New Zealand return in New Zealand. Say if the New Zealand tax resident taxpayer only receives salary, New Zealand salary, New Zealand interest, and because salary and interest where tax is already deducted at source, then they actually don't need to file a New Zealand return. IRD will just auto assess it, and then that's all done for them.
No, that's really interesting. And let's get into, I guess, the personal tax rates in New Zealand. So, I mean, if we contrast it to Australia, so our top marginal tax bracket or tax rate, so once you're earning more than 190,000 Australian dollars, your tax rate is 45%. And then we have a Medicare levy here as well of 2% that you're subject to. So top marginal tax bracket here or rate here in Australia is 47%. What does that kind of look like in New Zealand?
Yeah, so slightly, our highest marginal tax rate is lower than you guys, and we are 39%, and it's progressive. So it starts at like 10.5, 17.5, 30%, 33%, and then as your income increases, then the tax percentage increases as well. So we will have something called the ACC, which is a workplace insurance, and that's kind of part of the tax that's paid, and then that goes to the ACC.
Okay.
We don't have any Medicare. We've got KiwiSaver, but that's not compulsory. It is optional, but most New Zealanders are in KiwiSaver, just to save up for retirement.
Yeah. Well, that's probably a good segue to get into the next segment of the podcast. So, KiwiSaver. So, can you explain how KiwiSaver works for Australians working in New Zealand? So, I mean, first and foremost, is KiwiSaver available for an Australian who is a tax resident in New Zealand and working in New Zealand?
Yes, I think so. KiwiSaver, from what I understand, is that it would apply to people working in New Zealand. But I think it may be optional for Australians where they may receive Australian continue to receive Australian super. I think they call it the compulsory. So I'm not familiar with Australian. It's a compulsory
super guarantee is what it's called at SG. Super guarantee.
Super guarantee. Okay, from the Australian from the Australian employer, because we've seen cases where the Australian person who moved to New Zealand become a New Zealand tax resident, and because they're still working for the Australian employer, and the Australian employer is still giving them the Australian super, they kind of choose not to have KiwiSaver because they're getting it. So I think it depends on the facts in the taxpayer case, and but if the employer is in New Zealand, then KiwiSaver would probably be offered from the New Zealand employer to the new migrant from Australia, and there is a minimum of 3.5% contribution for KiwiSaver. Of course, that if they want to contribute more, that would need to be negotiated with the employer, but a minimum is 3.5, and then the employer needs to match with the employee's contribution. And then at the end of the year, if the taxpayer contributes enough, then the government will also contribute $260 around about for at the end of the year. So so there's I think 3 party contributes to it: the government, the employer, and the employee.
Yeah, so I can see I've seen a few clients opt into KiwiSaver, just opting in for the minimum 3.5%, because it's typically worthwhile doing, because your employer has to match up to that 3.5%, so it's additional kind of retirement income. And then the government contribution, as you said, is a good incentive as well. I think if you contribute up to I think it's 1,050 approximately New Zealand dollars, the New Zealand government will match up to 25% of that. So that's that 260 that you mentioned there as well.
Yeah, I mean, when it started, the government contribution was around $1,000.
It was more.
And then it reduces over time, and now we're now with 260. And also there has been talks about KiwiSaver minimum contribution will also increase and starting to get closer to Australians compulsory super percentage. So, but currently it's 3.5 at the moment. But the prospect is that it will keep going up.
Yeah, absolutely. Yeah, and I think just for listeners who are thinking about KiwiSaver and thinking about how it might differ from Australian super and the employer super guarantee contributions that we receive. What I found interesting is with Australian super guarantee contributions, so that's where an employer must pay 12% of your base, typically your base wages, and deposit that into your Australian super account. That's 12% of your gross wage, and then that typically is not subject to tax for you personally. It's subject to tax within your Australian superannuation fund at a more concessional tax rate. What I found interesting with KiwiSaver is the contribution is made from after-tax funds. So you get your salary, tax comes out, and then you've got your net wage, and then the net wage, the amount that you've allocated to go to KiwiSaver, so it might be 3.5%. That goes into your KiwiSaver, but it comes from your after-tax income, which is a little bit different from, I guess, the super contributions here in Australia.
I see.
And then if we kind of look at the KiwiSaver funds in a little bit more detail, so I understand when money goes into a New Zealand KiwiSaver, the funds are naturally invested, and they're invested through these structures called portfolio investment entities or PIEs. So can you give listeners a bit of context around how the investment earnings within a KiwiSaver PIE are taxed?
So the income that's derived from the PIEs are taxed at the prescribed investor rate, so 10.5, 17.5, and 28% is the maximum. In the end of the year, the fund will work out, okay, what is the income that's been derived by that taxpayer, then they will apply the appropriate kind of tax rate, and they would the PIR rate would be focused on the taxable income of the last 2 income years of the taxpayer to work out what is the right tax rate for them. If the correct PIR rate is been chosen and withheld, there's no need for the taxpayer to include the portfolio investment entity income in the tax return. But if the incorrect PIR rate has been selected and withheld, then there is a need to include that portfolio investment entity income in the return. If the taxpayer, I think it's good to get the correct rate. Then it's just treated as excluded income and not needing to report in the tax return.
Okay, no, that's really helpful. So typically, tax rate is anywhere between the tax rate on the funds invested in a KiwiSaver is typically between 10.5 to 28%. And that rate is determined by your average income over the last two income years in New Zealand. Yeah, okay. And then I think, for many Australians living in New Zealand, typically they will look to return to Australia at some point. Not all, of course. There's a lot of Australians that look to retire in New Zealand. So when it comes to moving KiwiSaver funds back to Australia, I'm regularly asked about, what options are available. So, can a KiwiSaver retirement account or a KiwiSaver fund be moved into an Australian superannuation account? And the answer is yes. So there's what's called the Tasman Retirement Savings Portability Scheme. So quite unique that Australia has this scheme in place. They don't have schemes like this in place with many other countries, not to my knowledge. But essentially, for Australian expats listing it in New Zealand, it is possible to move your KiwiSaver from New Zealand back into an Australian superannuation account. Typically, you just need to have a tax file number in Australia, and the decision to move back needs to be a little bit more permanent in nature. So if you permanently relocated back to Australia, typically you're eligible. The issue that I see from time to time is there's just not a lot of Australian super accounts that will accept New Zealand's KiwiSaver. I think for the most part, there's a lot of administration attached to that for most Australian superannuation funds. And in fact, they have to kind of quarantine the KiwiSaver component separate from the Australian superannuation funds. So there are some kind of unique considerations there in terms of your options to move KiwiSaver back, but it is absolutely possible.
That's good to know.
And I think what's also interesting is typically the transfer from New Zealand's KiwiSaver to an Australian super fund is not taxable. There's no taxing kind of involved in that transaction, but it does. The transfer is subject to our Australian superannuation contribution limits. So in Australia, we have what's called non-concessional contribution limits or caps, and the transfer from the KiwiSaver typically has to be within that non-concessional contribution cap. So that can create certainly some planning opportunities, because if you, not planning opportunities, but certainly planning opportunities, but also some planning pitfalls. So if you're transferring more than the non-concessional contribution cap and you exceed that cap, that can have some adverse tax implications for you in Australia. So certainly always advise getting some advice before looking to transfer KiwiSaver back to an Australian super account. And then once the KiwiSaver arrives back in Australia, as I said before, it's kind of separated into a kind of quarantine component within the superannuation account. And then in terms of accessing those funds, the earliest you can access them is, I believe, 65, because you're subject to the New Zealand preservation rules or the New Zealand access rules. Which is quite interesting because in Australia, the earliest you can access super is age 60, so it's a little bit earlier. So that's also something to keep in mind there as well, in terms of you can't access it as early as you can access your Australian super. One thing I wanted to ask, so staying on the topic of, I guess, super, is, if we have, if an Australian moves to New Zealand, they have their Australian super there, they have their Australian super back in Australia still. Are there any tax implications for their Australian super in New Zealand with the IRD?
Yeah, so while the New Zealand tax resident holding the Australian super, there isn't any tax implication until there's withdrawal. And so at the time of withdrawal, we would first check whether it falls within the definition of an exempt Australian super fund. If it falls within that definition, that type of Australian super, then it's not taxable in New Zealand. But if it's not, then yes, then we need to apply the foreign superannuation lump sum withdrawal rules.
Okay.
And how that is worked out is the foreign superannuation lump sum withdrawal rules. There is a percentage for the longer the taxpayer's been living in New Zealand, the higher the percentage, and the higher the percentage has been considered New Zealand sourced income on that withdrawal. So if the person withdraws during the transitional residency period, there won't be any tax implication because that's considered foreign and sourced income. So the years of and the percentage that we would look at would be after the transitional residency period expires, and the percentages on that. So but for most cases that we've dealt with today, those Australian super we've seen, they are treated as exempt from New Zealand tax.
And is there like a series of criteria that determines whether it's an exempt super fund for New Zealand tax purposes?
Yeah, so that definition in the tax law, we need to check, and depending on the taxpayer and what that Australian super scheme type is,
Understood. So that kind of rounds out the conversation around KiwiSaver and Australian super, and kind of contrasting the two there. I wanted to get your thoughts and expertise on property and investments. Sure. So New Zealand in particular is well known for not having a broad-based capital gains tax, and this is certainly topical in the current political environment here in Australia, that there's been some significant changes to the capital gains tax rules that we have here in Australia. So just broadly, can you provide listeners with a bit of an understanding in terms of how capital is taxed in Australia if you don't have a broad-based capital gains tax?
Even though New Zealand doesn't have a capital gains tax regime in Australia, there are certain sections in the New Zealand income tax that can tax on capital gains. For instance, we talk about property. There's something called the Bright Line rules. So before the Bright Lines rules were implemented, there was a section which states that if the person purchased the property with an intention of disposal, that property will be subject to New Zealand tax when they sell it. And because it's quite hard for IRD to determine, what is the intention of the taxpayer, they've introduced something called the Bright Line test, where the property is purchased and sold within 2 years, then is subject to New Zealand tax. And that is essentially capital gains tax, really, because if they're going to tax you on the proceeds from the sale of a property that's purchased and sold within the 2 years, then that is a type of capital gains tax. So so if it's subject to tax, then we actually include the proceeds of the property sale into the tax return, and so it will be taxed at the personal marginal tax rate. So if it's a significant amount, then it can potentially be taxed at 39%. Yeah. So because some other countries I've seen, they actually have their own tax rate for capital gains tax.
Yeah.
So. And it's not included as part of the individual's, personal tax rate, and so it could be lower. But because of the changes, and not from the Australia side, it's actually because it double up, so it's 40-something%, right?
Yeah, so similar to New Zealand's in that, the capital gain that you realise on the sale of a property is just grouped in with all of your other assessable income and then taxed at your personal marginal tax rate. So just on that, so for an Australian, if we look at property as an asset class, if you've got for an Australian expat living in New Zealand, they're no longer a transitional tax resident. So let's say they've been living there for more than 4 years. They sell an investment property in Australia. Now, of course, Australia, the Australian tax office will continue to tax Australian real estate, for even though regardless if you're a non-resident or a resident for tax purposes of Australia. So even if you're a non-resident of Australia for tax purposes living in New Zealand, you will still be subject to Australian taxes on the growth or the capital growth on the sale of that property. So that's kind of just highlighting the Australian tax situation. But in this scenario, would the Australian that's in New Zealand, how would they need to report that transaction in their New Zealand tax return?
So you're saying the Australian live in New Zealand and still own a investment property?
Yeah, that's right.
I see.
And they've just sold it.
So we'll first consider whether the Australian living in New Zealand is a transitional resident first. Because if they are transitional resident, then any capital gains from Australia or
just outside the scope.
Australian rental income, it's not subject to New Zealand tax.
Yep.
But if they're not a transitional resident, then the rental income would need to be reported in New Zealand, and we would expect Australia to have the first taxing right to the Australian income because the property is located there. So we claim a foreign tax credit in the New Zealand return when we report the Australian rental income. If there is capital gains that needs to be reported from if Australia, if the taxpayer paid Australian capital gains tax, we would first understand whether that property transaction is subject to New Zealand tax. If it's not, then we won't include it in that process in the income tax return. But if it is, then we would include it. So we won't assume that because Australian capital gains tax apply, then we have to include it in the New Zealand return. We will actually apply the New Zealand tax rules on the property transaction, on the sale, to determine. Yeah,
okay. And is that like a straightforward set of rules to determine if that transaction would be taxable in New Zealand?
So the property tax rules are set out in section CB6A to CB14. We will go through each of these sections to see if the sale falls within any of these sections, and then if one of the section applies, then we will look at would any of the exemption applies. So there's 4 key exemption. There's the farmland, the business premises exemption, the main home exemption, and the investment exemption. So if one of the exemption apply, then that takes it out of the New Zealand tax net.
Yeah. Okay.
But if none of the exemption apply, then we would need to work out the tax, New Zealand tax on the proceeds from the sale. So there is a series of steps to kind of determine whether the sale of the property.
Yeah, okay. But that's good to know that there is some concessions are available if the tax. I mean, in most cases, the taxation is going to occur in Australia in the first instance, and then any tax that you're paying to the Australian tax office on that capital gain should in most cases cover a large portion of any tax that might be payable in New Zealand on that capital gain anyway.
Yeah, so say if we do need to report the sale of the proceeds from the sale of the Australian property transaction, we will claim any Australian tax paid in the New Zealand return. Yeah, so there's no double tax.
So, yeah. And then how about shares? So we've touched on property. So say for an Australian living in New Zealand, they've got a share portfolio. They might have some exchange traded funds. I think it's worth pointing out as well, what's quite interesting with the Australian tax rules is once you've ceased tax residency in Australia, the capital growth on your shares is no longer subject to Australian capital gains tax. So for an Australian living in New Zealand who's still got a share portfolio back home, How does that kind of work? How does I know New Zealand doesn't have a broad-based capital gains tax rule, but how would the sale of shares be subject to taxation in New Zealand?
We would first, like similar to my previous answers, check whether the taxpayer is a transitional resident.
Yep.
If they are not, then that's when we look at, okay, what are the New Zealand tax implications on the Australian shares. So we would first look at, okay, well, because these are foreign shares, we would consider the foreign investment fund rules. There are more than 10 exemptions on the foreign investment fund rules, and we would check whether these Australian shares falls within any of these fifth exemptions.
Yep.
One of the there's a few fifth exemption that is actually relating to Australian related entities. So, for instance, one of them is Australian listed shares.
Yeah.
If in your case the client was had Australian listed shares, they're actually exempt from the fifth rules, and we can just apply the normal dividend rules. So maybe for the listeners who are not familiar with the fifth rules, fifth foreign investment fund rules essentially tax income on accrual basis and not on cash basis. So what I mean is, even if the taxpayer did not receive any Australian dividends, the foreign investment fund rule can tax on deemed income, and a maximum is the 5% of the opening market value plus any quick sale adjustment. So it's like taxing income on accrual basis, the foreign investment fund rules.
Or even unrealized gains, you could kind of think about it like that too.
Yeah, so there's been a new myth because of the people are not very happy with that being unrealized income being taxed. There's been a new method that's been introduced, and it's called the revenue account method. And essentially, if the taxpayer chooses to use that method, they will need to report all the dividend plus 70% of the gains from the sale of the shares. So that is a new method, but not quite. I think we need to look at the taxpayer's situation to see if they could use that method or not. There is the revenue account method. So revenue account method is essentially for taxpayers that doesn't have that are holding like unlisted shares. But then there's also something called the extended revenue account method. It's for more targeted to US citizens, and because they have to deal with double tax, and those are for listed and unlisted for the US. So we need to look at the taxpayers' circumstance to see if they could actually use that new method, and whether that actually works in their favor. Because it might not. Then might as well just stick with their traditional foreign investment fund rules method, which is the fair dividend rate method and the comparative value method. Each year we could take the lower of the two to report fifth income.
So I think just to sum up what you've said there, it sounds like, while there's somewhat of a consensus that New Zealand doesn't have a capital gains tax, certainly it's not the case where if you're selling capital assets outside of New Zealand that there's not going to be any tax implications. That's certainly not the case, and it sounds like it's more so New Zealand may still, depending on if you meet one of those exemptions, you may still be subject to New Zealand taxes on a deemed basis, particularly the shares.
But it's very fact specific. So maybe it's best for the taxpayer to get some advice around it.
And I think with anything relating to tax law, it's very dependent on the criteria, and that there's so many varying pieces of criteria that you have to meet in order to get the exemption in the final instance there.
Yes, definitely.
So just some final questions that I've got for you, Connie. So for Australians moving to New Zealand, what are some of the biggest tax mistakes you see Australians make?
I think at the start we talked about how people think that they've already paid the tax overseas, so they don't need to report overseas income in New Zealand, and then that and if that's been omitted for like say 10-20 years, then that becomes a big problem because tax has been underpaid for 10-20 years.
Yep.
And if IRD knocks on the door and asks about it, then that's when they will need to attend to it. There is also usually the process is that they would do a voluntary disclosure to report the overseas income. So that's one thing that we've seen. The other thing we've seen is not knowing about the fifth rules, because I don't think it's that obvious, because people just see what comes in as the Australian dividend and not think about seeing other rules to apply. And I think not keeping good enough records for the reporting, and also determining tax residency. Have they when they become a New Zealand tax resident or so.
Yeah. Absolutely. And I think from my end as a financial planner, working with clients, Australians moving to New Zealand, I think one of the biggest mistakes we see is not understanding your change in Australian tax residency status. So when you become a non-resident for Australian tax purposes, the way in which your assets and your income tax moving forward drastically changes. And I think particularly with New Zealand's, I believe the transitional tax residency rules are such a great opportunity to really kind of make the most of your time in New Zealand during those first 4 years, and looking to invest during that time can be super advantageous for Australian expats.
Definitely.
And for someone listening to today's episode who's either planning to move to New Zealand or is already living in New Zealand, what's probably the most important piece of advice that you'd leave them with?
Get advice early before the move, so that they could do tax planning, and then also maximize the transitional residency period, because we've seen cases where we could actually extend the transitional residency period longer than 4 years. So that would be advantageous if the person has a lot of overseas assets and investment. So I think getting advice early.
I think ultimately it's such an unknown kind of territory for most Australians as they're moving to a completely new tax jurisdiction. So I think getting advice obviously is the most obvious, but the most important as well. Not only just to ensure that you don't fall victim of any tax pitfalls, but to truly maximize your situation while living abroad, for sure. Well, thanks so much for joining us today, Connie. It's been so great getting your insights and your knowledge on New Zealand taxes. So where can listeners learn more about your work and what you do?
So listeners can go onto our company's website, and it's www.nztaxprop, so it's about nztaxprop.co.nz. We've got all our contact details there, and our services that we offer, and our pricing as well, so we're very transparent on that as well. So website would be the to reach us. And I really wanted to thank you for the opportunity to join you in this podcast and the invite. And I've learned a lot about Australian rules from you as well. So thanks for sharing.
My pleasure. Knowledge. Well, so great to have you on, Connie. And thanks everyone for tuning into today's episode of Behind the Advice Australia. And we look forward to seeing you again in the future. Thanks, guys.
Thank you.
Thanks for tuning in to today's episode. If you want to learn more about Runway Wealth Management and how we help Australian expats, feel free to jump onto our website, runwaywealth.com, and we're also on all the social media platforms.